Guys, good morning. I've got my water. Happy Saturday to you. I want to briefly talk about why banks are failing. Hopefully the feed's okay. I know sometimes it's a bit glitchy because I'd be driving, but it's the only time I have to talk to you, and I think it's important that I talk to you and keep you updated with everything that's going on in the world, because things are changing rapid fast and you really have to pay attention. So good morning everyone, good to see you on, or whenever you're catching this, afternoon, evening, good night. Do me a favour, as always, just hit the like button. We call it your daily exercise. It helps the algorithm of social medias. Try and push this information out there. My journey, my job, my goal is to try and educate as many people as I can. Most of it's done for free over my social medias. Full disclosure, I have a company, I do paid consulting. I'm on the way up to the office now to meet a couple of clients to build plans to retire early. But I want to talk to you this morning about how the banks are going bankrupt. Okay, what's going on? Like, how does a bank go bankrupt? Sure, a bank is a safe place to put your money. You walk into the bank, you give them the money, they open up the vault, they put the money in. Let me just get out here. Lovely stuff. So what's going on? And I'm going to speak everything that's happening in the US, because that's where I have the data from. God knows what's happening in Europe, okay? But the European Central Bank seems to be in a worse predicament than the Fed. The Fed, okay? The Federal Reserve, okay, is the Central Bank of America. Forgot my watch. Okay? And they dictate the price of money. And this dictates everything that happens in our world. It dictates the whole world economy. So if you're interested in money, or having more money, you should be interested in what's happening with the Fed, because that'll dictate, you know, how your assets perform, how your business performs, how everything performs. So we pay a lot of attention to what the Federal Reserve say and do. We also pay attention to what the European Central Bank say and do. They're a little bit slower. We're going to see them acting on this. That's why I think we're getting a warning. We're getting to see what's to come, and therefore when we have the information, we can position ourselves, we can protect ourselves accordingly. So how does a bank fail? A bank fails, okay, when you go, let's start at the very beginning. When you deposit your money in the bank owns that money. Most people don't realise that, because you're not taught about this in school, okay, and it's of design. So when we go and deposit money in the bank is now the legal owner of that money, okay? They own it, they get to do what they want with it. And you might find that's why it's difficult to get your money back from the bank. They ask you so much questions. And if you want to withdraw it all in cash, they just won't give it to you. And you can scratch your head and go, it's my money, why won't you give it back to me? Okay, or if you want to buy something and the bank don't want you to buy it, you just won't be able to buy it. So the bank owns the money, okay, and you become what's called a creditor of the bank, okay? So you've credited the bank, you're a creditor. Should the bank go bankrupt, you're just a creditor in the Chapter 11, or whatever we call it, in the bankruptcy, that you are owed this money, okay? So you don't own the money, the bank owns the money, they blew it up, and they now owe it to you, they have a debt obligation to you, okay? So that's the first thing. So banks have to make money. How do banks make money? Banks basically take your money when you put it in the bank, and they go and invest it into risk, okay? How do I know it's risk? Because you can't make money unless there's risk. It's just how money and financial markets work, okay? To make money there must be risk. Generally they're trying to invest it into lower risk things, okay? But as what happened in COVID, when we took interest rates right to zero, okay, banks used to be able to buy, you know, short-term fund, like they used to be able to buy, say, 6 months bonds and earn some money on them. But because the interest was so low on them, they had to go out the risk curve. They had to buy longer duration bonds with your money, okay, or with our money. They had to buy longer duration bonds, because the short-term bonds, okay, which, imagine a bank locks up money for 3 months. It's okay, because, you know, if it keeps rolling over loads of 3-month bonds, it always has liquidity, it always has money, okay? But when a bank starts buying longer duration bonds, now it can struggle for liquidity, it can struggle for money, because let's say it has all its funds locked up, and this is what happened Silicon Valley Bank, which was the second largest bank failure ever in the US. So there's actually a huge crisis going on over there right now. Hopefully you guys are aware of it, because you need to pay attention to what's happening in our banks. They may not be as safe as we've been told as kids, okay? So Silicon Valley Bank, because they couldn't earn money on the short-term bonds, they had to go out the risk curve, so they had to go looking for longer term bonds. All right, now they ended up buying bonds, 10-year treasury bonds. So that's basically they're loaning money to the US government, and the US government is promising to pay them back. Now I think it was under 2%, it was 1 point something percent, let's say 1.5% interest they were earning on these treasuries. All right, and that was the best they could get at the time during COVID, because interest rates were zero. So they were above zero. They were like, yeah, we'll take that, we'll do that. The problem is, during the pandemic, the Federal Reserve said, we are not thinking about raising rates. We're not going to raise interest rates. Interest rates are going to stay like this for 4 years. So all the banks made their decisions on that information, that it was going to be 4 years, we're not going to touch interest rates. So they were able to make their risk bets thinking that interest rates stayed at zero for 4 years. Okay? Then what happened last year? The Federal Reserve done a massive pivot. Okay? And they're like, holy crap, inflation is 6%, then it was 7%, then it was 8%, 9%. Okay, it got to almost 10% on the official figures, and the official figures are doctored. Like the real inflation is way higher than that. You guys know that. If you're buying anything, there's nothing that's just gone up 10%. Okay, so they had to do something about it. So they started raising interest rates. Okay, now all the banks are caught in a bad position now. All the banks, likely. Okay, they done analysis, and people have figures of 200 to 300 of the American banks are all caught in the same position that Silicon Valley Bank is caught in, and it's only a matter of time. This is why Balaji has this $1 million bet on Bitcoin, because he sees a full-on global financial collapse happening within 90 days, which is crazy stuff to think of. And none of us want that to happen. I'm happy if Bitcoin chips away to $1 million, as it will. I don't want it to happen in 90 days, because the world will be in turmoil. It'll be a really bad place for a lot of people, including myself. Like, the whole world will just go to shit. Alright, but we must understand, so we're prepared for this stuff. Okay, because maybe it doesn't happen in 90 days, maybe it happens in 2 years, but at least you have the information. So the banks are all caught with these 10-year bonds, so that means their money is locked up for 10 years. Okay, now the problem is, interest rates are now 4.5%, almost 5%. So the banks could have made much more money if they had all their liquidity, if they bought the short-term bonds. But the Federal Reserve, by doing a pivot and telling them one thing and then changing their mind, doing the total opposite, basically screwed over all the banks. It caught them all in a really bad position. So now what's happening is, when the banks need money, liquidity, when people go in and go, banks aren't making money, they're actually losing their ass here, because interest rates are 4% and they're all locked into these treasury bonds that are giving them 1%. They're under pressure. As people start to realise that, I go, well, fuck this. I want to mitigate my banking risk. I'm going to take my money out of the bank. This is called the bank run. Okay? As I said earlier at the start of the video, when you go to the bank, they don't put your money, your cash, in a vault. Okay? Banks generally have very little money. Sure, you go in and ask them for 5 grand to buy a car, or 10 grand, and generally you have to order, you have to give them a week's notice. So there's literally no money in the bank. And this is the way banks operate. It's called fractional reserve. Okay, it means that they only have to have a fraction in reserve of their obligations. So they might have a debt obligation, let's say of $1 million, they only need to keep 100 grand. And during COVID, that was taken right down to, I don't even know, I think it was 0. Okay, so they didn't have to have any money on reserve. So they went and locked all the money up in these long-term treasury bonds, and now people are getting spooked, and they're going, banks are losing their ass, I'm taking my money out, I'm going to move my money out of that bank. The problem is, they don't have access to the money. That if everyone goes to the bank and looks for their money at the one time, the bank fails. All bank fails. Okay? But because these banks now have their money locked in the 10-year treasuries, what happens? They can raise liquidity, okay? They can get money, but it means they have to sell these bonds. Now, these bonds are worthless. Not worthless, but they're worth a hell of a lot less than the bank paid for them. Because the bank, you're selling something that's giving you a 1.5 interest rate, they have to hold for 10 years. When you can just... You can get a short-term bond that'll pay you 4% or 2% or 3%, okay? So it's much more attractive to do that. There's much more risk, and you earn more money. So these long-term bonds that the banks have to sell, you know, they're selling them for like 70 cents on the dollar or 50 cents on the dollar. So they're taking huge haircuts, huge losses. And remember, where did the banks get the money? It was creditors' money. What does that mean? It was depositors' money, okay? So they're basically destroying their depositors' value. Meaning, when they sell the bonds, at this 50 cent on the dollar, 70 cents on the dollar, whatever it is, they take the haircut. They cannot return all the money of all the people who deposited the money. Never mind the fact that they can't return it now, not even in the future can they return it, because they've lost the bloody money, because they've had to sell the bonds at a tremendous loss because of interest rates. A lot of banks are caught in this situation, okay? 4 of them have gone bankrupt. We're hearing more rumours of 2 more banks in Europe. Pay attention to this stuff, okay? It's just another use case for Bitcoin. It's a bank with no bail-ins, no bailouts, and you don't have to trust humans to manage risk, because it's just maths and code. And here's the irony, okay? What's going to happen now is capital, money is going to flood to bigger banks. It's going to move to bigger banks, okay? But the thing is about all traditional assets. Okay, people are going to take the money out of the bank, they're going to invest in the stock market, they're going to invest into gold, they're going to invest it into the bond market. Alright, the thing is, here's the really interesting game theory here. And guys, if you like this video, put a comment in and let me know if it makes sense, because I'm probably not the most qualified person to try and explain this to you, but I don't see anyone in Ireland who's actually trying to explain this to the Irish people, to teach them a little bit about how banks work and if there's banking risk and what's going on with the banks. But I'm doing my best here. Bitcoin is my area, so but I'm doing my best here. So let me know if any of it makes sense, and throw a little comment in as well. The thing is with all these assets, okay, the bigger they get, the more vulnerable they get, okay, the more risky they get. Alright, the more money that gets invested into a single company, the more risk that there is within that company. Alright, the more money that we throw at bonds, okay, the more risk there is. It's easy money. It just means that the interest payment that you'll be offered on the bonds just goes down and down and down. All right. Okay. Now bring Bitcoin into this. The bigger Bitcoin gets, the more money you throw at Bitcoin, the better it gets. It's like it's the only thing on the planet that I can see that as capital floods into it, it makes it better. It's a self-fulfilling prophecy. It's a self-fulfilling cycle. Okay. The bigger it gets, the more secure it gets. The bigger it gets, the better it performs. The better it performs, the bigger it gets. The bigger it gets, the better it performs. All right, and it's just this self-fulfilling loop is how Bitcoin works. And like, you might be realizing this, okay, and I might be realizing this with my couple of grand savings. All right, but billionaires are starting to click onto this, and billionaires, because I know a lot of Bitcoin influential people, billionaires are now calling up Bitcoiners, go, I need to have a meeting with you. I'm seriously worried about the bank, about my money in the bank. In the States, this is happening. Okay, so things are going on. Big players are realizing that they need to understand Bitcoin. They need to have it. It's your insurance, okay? I know I talk about it being digital gold, digital currency, digital property, a network to move value instantly and free. So basically replacing all payment networks in the world. But it's also insurance. It's insurance on all this crazy nonsense that's going on. All right? And we talked about CBDCs. So like, how many points have I listed there? That's maybe 6-7 points. If I didn't have to run in and grab a coffee here before I go to the office, I'd give you more. So there's absolutely no reason why you ignore this thing. It's the single most important thing that anyone should do. There's 2 things, I think. First principles I live my life by, okay? And that means what's the biggest domino you can knock down? Well, forget about, because we all have a million dominoes in front of us. Oh, I need to that, I need to that, I need to that, I need that, I need that. We've all these tasks, micro tasks, and then they get bigger and bigger and bigger. But I'm like, first principles all my life. What's the biggest massive domino that's going to have the biggest impact in my life? I need to knock that down first. And I believe for every single person on this planet, it's understanding Bitcoin, okay? And you know, my second thing is learning to fast, because that's the single most powerful thing anyone can do for their health. If you want to find out more about that, follow Fasting with Dinny. I do group fasts. I've got a group fast starting next week. Shameless plug. But that is the crack, guys. I'm going to jump off, grab a coffee, head into the office. I look forward to chatting to you all soon. If you liked the video, give it a like, give it a love, give it a comment, have a question. Have a super day, Dinny out.